Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. Unfortunately, Mike Radkay was supposed to be the presenter, but Mike's having some technical difficulties, so therefore I will present ISE FX options. I put this together about 10 weeks ago for a group that was interested in currency options, how they work, what are they. They really understood index options, ETF options, equity options, and wanted to understand why somebody would use a currency option. I know a lot of you understand why you would use currency options, but bear with me. This is a pretty recent presentation I've delivered, so I hope you enjoy it. We'll get through it hopefully as quick as possible, and then you can ask me any questions you might have. So what we'll do, again, we'll just open up the questions. Type in any other questions that you might have regarding currency options. A lot happening today. As I said, big mover today, Australian dollar taking it on the chin. The U.S. dollar is weak against the Swiss franc and the Japanese yen. If you have a different view of all that, you should look at the ISE FX option symbols and trade the one that you feel most comfortable with. I'd urge you to learn more about options. Where can you learn that? Well, here at ISE FX Options, you could definitely learn a lot, as well as optionseducation.org. Please get a copy of the characteristics and risks of standardized options, and you can definitely go to optionseducation.org. Please do not trade anything you don't fully understand. Taxes, margin, and commission are not included in any of the examples that I would give today. So there are options on many, many, many different asset classes. I think you're all familiar with these, the ETFs, equities, equity index, currencies, and that's what we're going to be talking about today, currency options. Unfortunately, again, my apologies, Mike Radkay couldn't make it today, so I'm pinch hitting for Mike, and I hope you enjoy the presentation. So what is currency trading? I think a lot of you know what it is. It's the ability to move your money from one to another. So if you're in Canada, you can move your money out of Canadian dollars into U.S. dollars or vice versa. And this is priced each day on the spot markets. So right now, as I speak, the Australian dollar is trading about 99.76, basically parity. The Canadian dollar is also about parity against the U.S. dollar. So if you have a view, you have opportunities. What is money? Well, we know it's a medium of exchange. It's a unit of account. And it's also supposedly a store of value, although there's been a lot of articles written about that. The store of value isn't so good. We know that a lot of currencies depreciate, some more than others. You lose your purchasing power. And again, that's another reason why you need to invest. But you can flop from one currency to another. And some currencies obviously do very well, and others are poor laggers or poor performers. So how is this currency used? Well, we use it for trade. We use it for investment. We use it for savings. We also use it for speculation. And so it doesn't have to be used for speculation, but again, trade, investment, savings, and speculation. The fundamental currency factors, economic factors, such as monetary and fiscal policies, government budget deficits, and surpluses, balance of trade, inflation, economic growth. These are factors. These factors, and a friend of mine reminds me of this, if you look at budget deficits, there's no correlation between the deficit and the currency. It could diverge for years, and sometimes maybe not. So that, again, lots of ways to look at it. I just want to take one more look. And Mike's still trying to join us. I'm just trying to see if Mike's in the house here or not. I'm going to keep delivering it. Political conditions and market psychology, so ultimately supply and demand drive all financial markets. I think we all know that, especially, I guess we're seeing that today. Great concept, risk aversion versus risk appetite. So if you take a look at the Australian dollar today, that is the surrogate for risk, at least in the larger currencies. Again, the Australian dollar I watch very closely, and you can see risk aversion versus risk appetite. Let's see, Mike says he's in the house. I'm not sure. Oh, there you are, Mike. Okay. So I'll make you a panelist. Well, actually, if Mike, have you called in? I think you got to hit #6 to unmute your mic, Mike. I'm going to keep going until we can hear Mike. All traders prefer higher rates of return. So that's the idea of risk aversion, risk appetite, is that if you're not looking for a higher rate, you're taking more risk. So those higher rates also have the risk of potential devaluation, at least theoretically. Currency that fails to live up to those expectations. Some currency lingo, and a lot of you are familiar with this. Dollar strength, dollar weakness, risk appetite versus risk aversion, the quote-unquote carry trade, liquidity, currency flows, balancing trade, quantitative easing, 1, 2, 3, 4, 5, who knows how many we're going to have of those, and central bank intervention. And once we can, if Mike calls in, then we'll be good. He might have to hit #6. Mike, you there? #6 or *6, I think unmutes, Mike. I can't unmute it. Currencies are relative, so all currencies, and very often I'll be giving a presentation. Mike, are you there?
I'm here now. Can you hear me, Steve?
Yep, can hear you. All right, so we'll get started. Here's Mike Radkay. Sorry, I apologize. Thanks, Mike, for joining us, and I'll deliver that other presentation on another day. So here's Mike Radkay. He's the president of RDS Trader. And Mike was nice enough to put these slides together, and he's going to show you his methodologies for FX trading. Mike, thanks for joining us here at the ISE.
Thank you very much. Steve, just one quick question. Are you going to go through the slides, or do I just do that on my end?
No, I'm going to give you you should be able to drive the slides now.
Okay, I hope that'll be there. Thanks, everybody, for being patient. I was just having some computer issues coming through, but dealing with the technology all the time and all that stuff is so much fun in the computer age. I used to do this all in the trading pit, and everything's now into the screen. So hopefully I'll be able to keep working my way through it. But as Steve said, my name is Mike Radkay. I started out in the business in 1989 as a runner in a 30-year bond pit and worked my way to a broker to actually self-funded trader by 1997, and I've been trading for myself ever since. And I know the audience that I'm with, a lot of you are options traders, and you trade a bit differently than I do. But when I got off the screen and when I got off the trading floor, I had to trade different as well. I trade less now. I trade maybe 1, 2 opportunities in a day. I do some intraday swing type ideas, but I do have a bigger term perspective, as I know that many traders have different types of styles and different types of approaches towards the markets. But support and resistance, depending upon your time frame and where the market, where you want to participate, becomes a key as to what you want to get involved in. So I'm just going to go through some of these slides to give you a feel for some of the things that I begin to do as I work through a market. And again, I don't know if some of you can answer some in, but I do ask some questions, and maybe I'll just ask them out there, and then you could think about them yourself. And if you have further questions, at the end, you could also email those to me at the end of the presentation with that information that you see right there. So I'm trying to, one is to get to the point where I can flip to the next slide and see where that's
Should
at.
be able to hit down arrow. I mean, you have controls now, Mike. So if you just hit your down arrow.
Gotcha.
Yep,
all right, I got you. All right, we're good. So again, this is some information about me. You don't have to read through that. You can check out our websites. But this upper left-hand picture is me in the trading pit. So again, my life has definitely done a 180 in terms of change of how I do business. I did it standing up for years, yelling and screaming, and now push my way to the computer screen. So one of the first things I did was, well, you build a game plan, you build some risk tools, and you build some analysis tools to help you, give you the confidence to participate in the market. And I begin to first, I know there's some slides that Steve may have put in here too, so from there you can take a look at some of these slides when we're done. But obviously, you know, there's risk, and any ideas that I do here, I do them live. I know you understand that you can't lose in this game, so we always put those type of disclaimers in there. But one of the first things I begin to look at, and I know you do, and everybody does as well, and it's something I learned when I got my degree from Lake Forest College, a Division III school, liberal arts school, just 30 miles north of Chicago. And one of the biggest things that stands out, other than the forecasting classes, was my Economics 101 and supply and demand. And of that, because this builds your bias. This definitely builds your bullish or your bearish bias on a market. And I heard Steve slightly saying when I came in, talking about the ISE and talking about how it fell today, and there's some things that are going on. And then we have the earthquake in New Zealand that is definitely creating some, adding to some of the downward fuel in the market today, and doing those types of things. There's some uncertainty and turmoil, of course, everywhere. But as we go up and down in price, I mean, supply and demand definitely is a factor. And one thing that always stands out in my mind in the 30-year bonds were when I learned to follow the money. And that's when I got to the screen, I was one of the first people to bring a handheld into the 30-year bond pit, because I knew that's where the money was starting to shift and go. But I say this in terms of what was going on, because there's back in the turn of the century there, at about 2000, 2001, 2002 era, the government decided to not issue 30-year bonds. And I should have taken a signal right from that point, is to start moving to the 10-year note. But the point is that I was doing well in the 30-year bonds, I was making money, but liquidity was definitely shifted out of the 30-year and went to the 10-year. Now the government has definitely reinstated some of the 30-year and brought some of that vibrancy back to that market when they started doing that. But it's a point of, you're following money. Money cyclically flows in and out. When everybody's fearful, they take money out of stocks and put it into fixed interest rates, and there's more demand, and that supply and demand is going to help push that market up and push that market down. And of course, when we have that fundamental event, or those unemployment figures, or what the Fed does in terms of interest rates, we have a low interest rate environment, and we've had for some time now, and the Fed is very accommodating. And you see currencies like the Swiss flip past parity and actually more valuable than the dollar. Now you see the same thing with the Canadian. You see some of that happening definitely over the last year or two with the yen, with the U.S. dollar against the yen, and that's what happens with the gold, and us, of course, fighting 3 wars and the way we spend money. I mean, that devalues our dollar, but it's not always that it's bullish or bearish. But again, it's where you build your confidence in your idea when you want to get involved in the market. So when I keep going, and I ask this of you, and if I could see some of you maybe put some responses, of this list that I put out here of these economic indicators that we all follow, the Fed looks at, everybody looks to these for getting.
Uh-oh. I think we lost Mike. Can everybody hear? Can anybody hear Mike at all? No. I assume everybody can hear me. Mike, are you there? All right. So we're waiting for Mike to hopefully call back in. Unfortunately, we lost, where confidence in the bias builds, we lost his connection. So I really don't want to deliver his material, so we'll have to wait a moment and hope that he calls back in. Well, this is Steve Meisinger, your host. We're waiting for Mike Radkay, the panelist. Let me see if I can contact him. Sorry about that, everyone. Let's see if we can get a hold of Mike, find out where he is. So as we speak, markets are getting pounded, and the Australian dollar, the one I watch, it seems to be the best way to look at the currency markets is to see what's going on in AUM, which is the Australian over the U.S. And right now we're trading around 99.79. The Australian dollar is down 1.6%. That's the big mover of the day. As I said, followed by, and Mike was mentioning this, the Swiss and the Japanese yen are actually rallying today. They're up about 0.5 and 0.6%. The British pound is down 0.7%, and the U.S. dollar is up 0.3% against the Canadian dollar. All right. Unfortunately, we're going to have to switch back to where I was, and we'll hopefully you guys are enjoying a doubleheader today, if you will. So all currencies are priced on a relative basis, so it's not good enough to say you don't like, for example, you're not bullish on the U.S. dollar. That's fine, but you got to find a currency you want to pair it up with. So if you're not bullish on the U.S., today would have been a good day to be looking, if you will, at the Swiss franc or the Japanese yen, because those they're rallying. But again, the U.S. dollar is rallying significantly against the Australian dollar today. When the economy expands or contracts, supply and demand is out of base. It's out of balance. Excuse me. In fact, this happens all the time. That happens all the time. Let me see if I can help Mike. He's lost the conference number. The conference number, Mike, I got to type this in, 450-862-3020, #. So capital is mobile. In fact, we know that that's what today's capital is very mobile, and it's moving away from the Australian dollar, moving away from the U.S. dollar. Really, the magnet for money today, at this moment that I speak, is the Swiss franc and the Japanese yen are taking the most money. Everybody is putting their money there. That doesn't mean it's the right place to be, but right now, that's where everybody's going. In fact, that's what we do when we're trading currencies. We're looking at this. The currency, the current account and the capital account is the BOP, if you will, balance of payments, is an accounting record for all monetary transactions between a country and the rest of the world. Currency markets watch this current account for potential indications. A little bit longer term, obviously. The current account shows the value that goes across borders. And Mike, you just need to call that number because you might have to hit #6 once you get in. If you do all that in #6, then you unmute. The capital count is the change in foreign ownership of domestic assets less the change in domestic ownership of foreign assets. And the capital count equals foreign direct investment plus portfolio investment plus other investment plus the reserve account. So I know it's technical, but sometimes people like that. Money has a price, and again, in fact, money is priced each and every moment. Mike, you there? Money has a price measured by currency rates and interest rates. So why would you import? Well, business needs. Sometimes there aren't any alternative goods. Citizens have currency to spend it away from their country. And research and development done at home, manufacturing done abroad. Why export? Well, natural resources are abundant. Citizens do not have currencies to spend, and currency demand for their goods. So think of this. There are some Mike is telling me, a different Mike, that he can't see my presentation. Can everybody else see currencies price money across borders?
Steve, can you hear me? Can everybody hear me?
You're back, Mike?
Yeah, I think I'm back. I'm sorry about all this, you guys, but I don't know what happened there.
Awesome. All right. All right, good. So now we're flip-flopping. Mike, thank you. Sorry about that, and we'll get back to Mike's presentation.
Thanks, everybody. Thanks for bearing with this. I don't know what happened, but that's technology. It's in the wires, but I'm going to try to give you some of the information to the best of my ability and move along here. I know you're
sorry about that, Mike. Thank you.
That's fun about the computers in this world, because I do trade multiple markets, not all of them at the same time, but keeping your mind active and going. And what I was talking about on the screen here are these economic reports that build our bias. And I was asking everybody out there, between 0 and 10, 0 being the worst and 10 being the best, your command of these types of reports that help move the market. I know some are more significant than others, but what do you think? If you give yourself a rating of your command of this and knowing bullish or bearish, what would you say in there? Because I know for me, I've gone, and you could, as I keep talking through, maybe you could put in a number through the Q&A or something in that nature to give yourself a feel, because, again, you need to expose your strengths and your weaknesses, as we have them all when we begin to trade, and there's different factors that influence us all the time. So I see that Don put a 7 in there, and there's a point of, if there's some of these reports that you don't know about or something, because one thing I learned back, on the trading floor was I used to elbow the guy next to me and ask me, hey, what's going on? And so now where I don't elbow the guy next to me and I say, I know what's going on and I respect price, because I'm going to date myself a little bit in my trading, but this is back in the day when Rubin was the Treasury Secretary, and one day he decided to resign. And he decided to do that in the middle of the day. In the market, the bonds started dropping, and I was long bonds. And I elbowed the guy next to me, and I said, hey, what's going on? As opposed to getting out of the trade and respecting what price was telling me, because price was starting to drop rapidly. And the one thing I do is I recover from those mistakes, learn from them, and get better. Because when I was on the trading floor during 9/11, I didn't elbow the guy next to me. I was short bonds before, and I felt it was right to do before that event. But smoke out of one tower, you say, hey, that's New York. But if you say the explosion out of the second tower, it's buy bonds, sell stocks. Don't ask questions, but prices just ran, and there's just some things that begin to happen. And even like today in the currency world with the earthquake in New Zealand and putting aside the ethical and moral implications of what's going on when people are suffering, but that's a bearish outcome for that country and that economy. And you see what the market did today. And there isn't a time to hesitate in some of those moments. So from there, you're just going to get to that point where you need to make these decisions, and sometimes you have to adjust your position, whether you're trading the underlying or whether you're trading options. But there's just definitely some volatility that definitely got ramped up that you need to be aware of based upon some fundamental news of what's going on. So just something there, begin to rate yourself on some of these slides that come through, and then hopefully that begins to give you a thought. Obviously, if you're trading the bond markets, the 30-year, 10-year, 5-year, 2-year type of idea, you need to be aware of these auctions. And, they do have implications on the currency rates as well, where interest rates are, and this type of stuff. So the point is that you have to be aware of, and you can prepare for these types of things before the market even presents what those results actually were.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.